Good evening, friends. After some time, after a few weeks, I think we are doing this future trend. And I must tell you that some of the data points that we have put this time purely based on the feedback that you people have given us. I'm really thankful that you people are giving us the inputs and that you want us to cover those topics in our future trend. So I'm very grateful for that. So I'm going to cover that, like someone suggested other day about ETF versus sovereign gold bond, which is better. So we have done that analysis also and part of this future trend. So let's be very honest, it's not a future trend, but it's just more of a data analysis. So we thought let's discuss those data analysis with you. But before I begin, just a small disclaimer that this webinar is just to enhance your understanding about the equity market. Please consult your financial advisor before buying and selling any stock. Investment in securities market are subject to market risk, and past performance no indicator of future returns. So, what I'm going to discuss about it today, I'm going to discuss about, and again, this is an input that coming in from various investors, that where do we stand in terms of price to earning buckets of BSE 200, BSE Midcap and BSE Small Cap. In conjunction that with where the Indian market stand in terms of price to earnings and price to book value compared to the other global markets. Then again, the third, we are going to discuss about the sovereign gold bond versus gold ETF, which is better. And I must tell you that it is also an eye-opener for me. How Indian currency has performed versus other emerging markets over a period of 5 years and 10 years. Why this question is more pertinent and important? A lot of our NRI customers wants to know what could be the potential return based on in the dollar terms. Because rupee do depreciates against the dollar, and if that is so, how much returns we can save off from the returns while computing this one. The one question that keeps coming, are mutual funds outperforming? I'll show you the data category wise, 1 year period, 3 years period, and the 5 years period. Is Bitcoin price movement suggest risk off? Why am I saying so? I'll show you some graph and then we can take a call on that. So let me start with my first data points, price earning bucket. So what we have done, basically we divided the BSE 200 basket into various bucket of price to earning. The first bucket is 0 to 20, then 20 to 30, 30 to 40, 40 to 50, 50 to 60, and more than 60. And then there is something called loss making also. We look at BSE 200 constituents, we look at BSE mid-cap constituents, and BSE small cap constituents. Why we have taken BSE mid-cap and small cap constituents? Because they consist the larger basket of the number of companies. And we try to see first thing, where does this, and this is in terms of market cap. What percentage you see, if I look at number of companies, then it will not give you a better idea. But what percentage of market in terms of market cap sits into which bucket? So when I look at it, the highest bucket in BSE 200 is more than 60, which is 26%. In BSE mid cap, it's 39%, and BSE small cap, 34%. When I look at more than 30%, more than 30 PE, which really takes the market to a little expensive zone, in BSE 200, more than 60 are in this bucket. If you look at it, let me put it this way now. This bucket is more than 30 PE is 60%. The moment I go to BSE mid cap and BSE small cap, this bucket is more than 70%. Why? Because only 28% in both the cases, BSE mid and small cap, are having PE less than 30, which gives us an idea how richly India's overall market is valued, and within that, mid and small cap. If 72% of the companies or of the market cap is commanding more than 30p, I think we need to be a little cautious. And one of the reasons we have been kept saying time and again that there is a fraud in the mid and small cap companies, and this data reinforces that statement. The margin for error is hardly there. If you make mistakes, probability is very, very high that you will stuck with that company for many, many years, and yet you will not make money. Why? The market will go up overall, but the company that you're holding in that portfolio may not go up if your stock selection is not good. I have been saying today, I have been saying in the past, and I will repeat in the future also, be careful of the momentum stocks. Don't get carried away by the recency bias. Don't get carried away by the herd mentality. Because probability is very, very high, you may underperform. The facts I'm putting in front of you, the choice is yours. Now this is based on the bucket of the market. The whole world is about relativity, am I right? मेरी शर्ट उसकी शर्ट से सफ़ेद कैसे? Am I right? And when I look at the global market versus Indian market, where do we stand? Indian market in terms of valuation is at top of the table. Just marginally below the SPX index, that is Standard & Poor's, which is commanding price to earning based FY 2024. Please pardon me, I think the heading has been little this. And this is future, okay? And future price to book value, while the US is 25.1, India is 24.6. And price to book value of 4.7, this is 4. In other words, India is commanding a very rich valuations as compared to global peers also. If you look at the emerging markets, which India is a part of, 13.6 versus 1.7 price to book value. Now, one school of thought can be that India is a what we call a growing market, higher ROE. It should command the better price to earning. Am I right? But how much? Should it be double of that? I think that's a question that we need to all ask. Like this is 1.7. Am I right? So that's, I don't know where do we stand actually. We are commanding a very rich valuations, and that clearly makes us believe that, so we have compared India in terms of price to earning and bucket wise, which bucket, what percentage of companies are in terms of market cap, and then we are comparing with the price to earning and price to book value of the global markets, which clearly gives an idea that Indian market is richly valued. Yes, we are going to be the fastest growing economy, no doubt about it. Is it there in the price? Or it's not there in the price, only time will tell. But right now it does give an indication that it is there in the price. Okay. Now coming to the very interesting topic. And this topic basically, someone asked us a question that this gentleman wanted to, and I don't know this gentleman is attending this webinar or not. He asked us, which is better? Should I buy sovereign gold bond or should I buy gold ETF? So we took one particular sovereign gold bond, and then at the same time you had a choice to invest in SGB and you had a choice to invest in gold ETF. I'm going to make this presentation 3 slides so that everyone understand And please listen to me very, very carefully. Even when I looked at the data, even it surprises me. This will help you to understand where you should be doing it, where you should be parking funds, given a choice between SGB and Gold ETF. So let me first explain you the parameters. While SGB gets 2.5% interest paid quarterly, semi-annually, every 6 months, ETF does not carry any rate of interest. In terms of tax treatment, SGB interest is taxed as per your income tax slab rate. So if you are in 10% bucket, you will be charged 10% tax on that interest income. If you are in 20%, it will get charged at 20%, and if you are in 30%, it will get charged in 30%. You can sell SGB, of course it will come at some discount, but if you do that, it will attract the capital gain tax, less than 3 years and so on and so forth. Same logic applies. But if you hold till the maturity, you don't pay any capital gain tax. On the other hand, there is no maturity in ETF, am I right? So what happens, depending upon your holding period, and I'll explain that what is holding period, which defines short term and long term, you do have to pay tax based on that. So while SGB, if you hold till maturity, you don't pay single rupee tax, which makes it very, very good. Liquidity, there's a little limited liquidity in SGB. Why? You have to. It's traded on the stock exchange by very limited quantity, and it comes at a discount. After 5 years, you can redeem the bond at the offer price on the interest payment dates. So after 5 years, you can get redeemed with this one. While ETF is a more liquid, you can actually sell as and when you want to do it because it daily gets traded on the exchanges. Now let's look at the returns part. And please spend more time on this because it's very, very... So what we have taken in one SGB, which was issued on 30th November 2015, sorry. The price at which was issued by RBI was 2684. And at that point of time, the ETF, we have taken ICICI ETF 23.66. And you hold, this is 8 years SGB, so 8 साल तक आपने रखा. After 8 years, RBI paid you 6132. And had you bought ETF, the value as on 30th November 2013 was 54.7. While ETF does not give you any interest, there is an interest you would have earned of 536, and I'm not looking at the time value of that. I'm just looking at absolute 536. In other words, your income, if you invested 2684, but your income is 6669. Why? 6132 plus 536. I'm adding those two items. While total income is 54.6 only when you invest in ETF. Am I right? So your pre-tax return on SGB is 148.5% versus ETF of 132. In other words, SGB at the pre-tax return scores over the ETF. But we all pay tax, am I right? I've assumed that when you invest in SGB, you earn 30% slab rate. Am I right? So you paid tax on interest is 161 rupees. Why? Because you would have paid this 536 rupees pay, 30% the tax is 161. While there is no interest, so there is no tax on that. Am I right? Since you hold till the maturity, you paid 0 capital gain tax. But here, you paid 3 rupees 39 paisa as a tax. This includes the grandfathering. Why grandfathering? Because Government of India came out with the Grandfathering Act on 30th January 2018. Plus, we have taken a cost of indexation which is allowed under ETF. And long-term capital gain is 20%, so we applied 20%. You end up paying 3 rupees 93 paisa as a tax. So what happens? The final value in SGB after paying capital gain and so on and so forth, and after paying tax and interest, comes to 6508. So you invested 2684. Your net income is 6508 at the end of this one, which gives you 142.5% returns. But in ETF, the final value comes to 50.77. Why 50.77? Because 50.70 is your tax. Before tax, you pay 3.93. Your value comes to 50.77. In other words, the post-tax returns on ETF is only 114% versus SGB is 142.5%. It is no-brainer. Pre-tax return, you are making more money in SGB as compared to ETF. And post-tax also, you make more money in SGB as compared to ETF. And the difference is huge. 142.5% versus 104.6%. Now, there is a catch. And the catch is that Government of India changed the cost, that capital gain tax, what we call this, on the ETF. Now what this says, it has divided ETF into two parts. The one you bought before 31st March 2023 and one you bought after 31st March 2023. So suppose you bought before 31st March 2023, that ETF will come at, if you are, it's a long term, that is hold for more than 36 months, not 12 months. Don't get confused with 12 months. If you hold for more than 36 months, it will be 20% capital gain tax plus indexation benefits. So your overall tax will be less than 20%. Why? Because you got an indexation benefit. But if you wish to buy now, then it will be taxed at personal income tax. In other words, if you're in 30% bracket, you are supposed to pay 30% tax on that. If you holding less than 36 months, whether you bought before 31st March or you bought after 31st March 2023, in both the cases, it will be taxed at personal income tax. So if you have to buy now, the ETF, your tax liability goes up much, much higher. Why? There is no cost of indexation available, no concessional rate of 20%. You will be charged at your personal income tax. And most of our investors would be in the 30% slab rate. And if that is so, ETF is not a very great idea if you don't need the money, am I right? Because ETF does have a liquidity benefit, but does not have the benefit of a returns. So given a choice between SGB and the ETF, it makes a lot of sense to go with the SGB, provided you do not want to get out before 8 years. And my request to, in fact, I must tell you that even this is a learning for me. If you remember, all this time I said that I have only 70 grams in SGB, but I have quite a substantial amount in the ETF. When I look at it, I think it makes a lot of sense to be in SGB, especially after 31st March 2023, because I fall under the highest tax bracket plus surcharge, which really makes my life difficult, because when I look at the post-tax returns, is not very healthy. So, if you wish to buy now, it's no-brainer, go for SGB. That's what I would request all of you to do that. And if for some reason it's available at discount in the secondary market, might as well buy that. Of course, your interest will get paid on the principal amount, not on the price at which you got buying in the market because of appreciation or depreciation, whatever the case may be. So please do that. In case if it is gone down from the issue date, it's all the more reason you will make more money. Why? Suppose, I'm just giving an example. The RBI issued SGB at 100 rupees. and you are getting at 98 rupees because price of gold has come down. I'm just giving an example, okay? Even though you bought at 98 rupees, the interest you will get is of 100 rupees. So your net yield goes beyond 2.5, more than 2.5%. So my suggestion would be remove ETF from your shopping basket at SGB when it comes to the gold allocation. I hope that's very clear cut. In case if it's still not clear, please ask me the question. I'll be more than happy to further clarify on that. So I spent some time in explaining that purely because the tax angle has changed, tax aspect has changed recently, and I used to be very much aware about this. Even I was not aware about it, let me be very honest with you. Now this question comes more often from our NRI customers. How much we should account for currency depreciation when we look at the returns in dollar terms, number one. Number two, how have Indian currencies performed as compared to other emerging markets in the world? Are we good performer, worst performer, and what not? So what we have done actually, we look at what was the Indian currency versus dollar 5 years back versus Indian currency 10 years back. Same way, we look at other 9 emerging markets of the world and then see where does the India stands in terms of currency depreciation in a period of 5 years, in a period of 10 years. I must tell you that data is very, very interesting. One of the best currency which has depreciated least in 10-year period among emerging markets is Chinese yuan. 18% only. If I look at the 5 year, on the contrary, Mexican pesos appreciated against the dollar. So that means it has done the best in 5 years period. But Indian currency in last 10 years has depreciated by 36%. Not annually, absolute. Why absolute? Because 10 years back, India rupee versus dollar rate was 61.20, which is now 83.5. So we have depreciated by 36%. Okay. And 5 years back, Indian value of dollar versus dollar was 68.9. That means we have depreciated by in 5 years 21%, isn't it? So what does this mean? On an average, in last 10 years, Indian currency has depreciated by 3.2%. But in 5 years, we have depreciated by 3.9%. In other words, if you to really adjust for that, you assume that 400 pips, my return will get compromised if I have to convert in dollar based on the historical trend. Having said that, I think Indian currency has done fantastically well as compared to some of the other currencies in the world. Why am I saying so? Korean won has gone down by 34% while we have gone by 36%, almost similar. Mexican peso also very similar. But if you look at South Africa, 71% last 10 years. Turkey has been disaster because of inflation, 1,400%. If you look at other emerging market, Argentina, 11,000. Poland has done better as compared to India, only down by 27%. Last 5 years also only down by 3%. But Indonesian rupee 39%, Brazilian lira 144%. So if you look at BRICS, I think except China, India has done reasonably well. Purely because of reform, purely because of good inflow coming in from the FDI and the FPI that really help us to retain that. But having said that, please budget for 400 bips decline in the returns if you have to convert into dollar on an average. So if Indian market has gone up by 50%, just give an example, last 1 year, when it comes to dollar, assume it is 46%. And that's how you should calculate your returns in your mind. Especially those who have a children's, what they want to send their children outside India. Remember that could be the depreciation you should budget for India versus rupee. This historical trend logically Indian currency should appreciate, but I don't think government will allow that for the very simple reason India's competitiveness basically takes a beating. Why? Your export will become expensive and import will become cheaper, which is not a good thing for the Indian manufacturers. Are mutual funds outperforming? This question keeps coming, and reason why we are saying so, because funds flow to the mutual fund has been very, very strong. Logically, when the funds are very, very strong, that means mutual funds should be doing extremely well. Am I right? And the data reveals that quite contrary. And I really heads off to the mutual fund investors. They understand the power of compounding. They have not stopped putting money despite mutual funds are underperforming. And look at the data. In last 1 year, if I have to look at the small cap index, only 17% schemes have outperformed their benchmark. Only 17%. But if you look at the flow to the small cap funds, it's very, very big. If you look at the mid cap, only 41% of the schemes have outperformed their benchmark in last 1 year. But the fund flow remains rock solid. Now go back to 3 years period. Only 24% of the mid-cap schemes have outperformed their respective benchmark. But if you look at the 3 years, fund flow to the mid-cap has been excellent. The best has been 57% large cap. It's like flipping a coin. Am I right? आपका लक अच्छा है तो अच्छा लार्ज कैप स्कीम मिल गया, नहीं तो खराब है तो. And when I look at the 3-5 years period, only 32% of the mid cap have outperformed their respective benchmark. Data does look little better for small cap with 79%. That's the best case. 100% of the schemes have not outperformed the benchmark. Yet people put money in the mutual fund scheme. Nothing wrong with that. That shows the level of maturity the investors have. कि अंडर परफॉर्म किया है पर आगे जाके शायद आउट परफॉर्म करेगा. एंड स्मॉल कैप दैट हैज हैपन. 1 year is 17%. If you expand the time horizon to 3 years, it's 55%. And if you go to expand the time horizon 5 years, it's 79%. So in other words, there is a high probability that if a small cap scheme which may have underperformed today but has a higher probability of outperforming over a longer period of time, that logic doesn't apply with the large cap. As you keep expanding, it has been declining. You see this. I can tell you with a lot of data this way I've done. Not 100% outperform over a longer period doesn't happen, even in mutual fund. There will be some scheme which will always underperform. But let's hope, very great respect to the mutual fund investors. Despite underperform, they don't stop their SIP. When it comes to PMS, people do get little perked up. Instead of putting more money, they said we'll put money when the performance improves. And that's a stark contrast between a PMS investors and the retail mutual fund investors. Sometimes I feel retail investors are behaving more matured manner as compared to HNI PMS investors. Now Bitcoin is a very, I don't invest in Bitcoin. But Bitcoin gives a very good idea about what is the psyche of the investors globally. Is there a risk on or risk of strategy happening globally? And what comes as a surprise to me that Bitcoin prices from its peak of 71,000 has come down to 57,000. In other words, it is down by almost 19% from its peak. 71,000 was not in very distant past. We saw that number in the month of June, from 71,000 to 57,000. Why it's very important for us to know. When there is a momentum, that means it's a risk-off strategy. Risk-on strategy. Bitcoin clearly reflects whether it's a risk-on or risk-off in this price movement. And data which I looked at it clearly tells me now it happened, there is a risk-off strategy, Bitcoins have corrected. Possibility is very high. We would see that percolating down to the equity market. So be careful. Sector rotation we had talked about time and again. Today is a classical example. We all know what happened to the IT sector today. Am I right? It significantly moved up. And today is a very funny thing, which is like while the market is overall 1% up, you look at the advance decline ratio. And that gives an idea. There were more declines as compared to advance, despite the market went up by almost 1%. And if you look at the Sensex contributor, you'll see why the Sensex is so high or Nifty is so high purely because of IT companies. Just to give an example, and let me take that example just to drive home the point. So, today we saw Sensex, right? And when I look at the contribution of Sensex today of 622 points, one company accounted for 1/3 of that gain, 232 points by TCS. 186 points accounted by Infosys. So when I combine Infosys and TCS, out of 622 points, more than 400 points are accounted by only two companies. And that explains why the market is up today. And yet, despite the market is up today, the advance decline is not in the favor of advance. How did the market behave? Sensex and Nifty are up by near about 0.7% for this week, while the Midcap as underperform is up by only 0.15%. Small cap is in red today, this week. It has gone down, and foreign investors have put in about 15,000 crore in the first 10 to 11 days of July 2024. With this, let's open the floor for question answer. Over to you. B. Bhaskaran sir, today Sunilji, great that you and Mr. Mohit addressing the current market and guide us through the time of confusion. Thanks a lot. My model portfolio shows a good amount of profit now. Our market value is on a higher side. Are we expecting correction? Is it good to realize the profit now? So if you are following a model portfolio, I don't think you need to be little worried about too much, because in model portfolio, we'll tell you when to exit and what to do that. And if you look at it, even if you look at our model portfolio, whether it's aggressive, moderate, or conservative, we have moved more towards the large caps in last a couple of months. So as far as the model portfolio is concerned, we will come back to you in case we have to do any corrections there. Rajendra Saha says, it appears that instead of financial parameters, the market runs on liquidity. What is your observation? What do we need to do in this scenario? Thanks. To Rajendra Bhai, you are absolutely right. Market is a function of liquidity and growth in earnings. These are the two pillars on which bull can survive. Even if the one is missing, the bull cannot survive. It needs both the engine to fire. So if there is no growth, but there is a market run little ahead of the fundamental, purely driven by liquidity, eventually it has to correct. What you need to do in this scenario? be careful. See, remember, I have been keep saying that time and again. Be careful of what you are buying in mid and small cap, because I again say people do run off a recency bias. जो कंपनी चला है, जो सेक्टर चला है, we want to all get into that, thinking that since it has worked well in the past, it will work well in the future too. नहीं होगा वो. As I told you, and that bifurcation of BSE 200 in terms of PE buckets, in terms of mid and small cap, you look at it, many companies are running ahead of the fundamentals. Some of the PSU stocks are commanding price to earning in excess of 70. How does it justify that kind of earnings, price to earning? So I think somewhere we need to be little congruent. Like, it looks excellent. कोई कंपनी ले लिया, चल गया, we feel very happy. अरे 20% रिटर्न हो गया, 30% रिटर्न हो गया. But will that get sustained? The answer is no. नहीं होगा वो. And hence I keep saying, सोना बेच के कॉपर मत खरीदो. People are making a very mistake, the same mistake that investors made आज से 5-6 साल पहले. They sold blue chip companies to get into the momentum. टाइटन बेच के पीसी ज्वेलर लिया. हाउसिंग डेवलपमेंट फाइनेंस कॉर्पोरेशन बेच के DHFL लिया. हिंदुस्तान यूनिलीवर बेच के मनपसंद बेवरेजेस लिया. Today people are selling the large cap to ride the mid and small cap momentum. They will have a very sorry state of affairs. अभी शॉर्ट टर्म में अच्छा लग रहा है, बहुत अच्छा लग रहा है, अरे स्मार्ट हूँ, मुझे समझ में आता है मार्केट क्या है, so and so forth. But I must tell you, you will pay a very heavy price. So my request would be, Rajendra bhai, in this scenario, what you should do? Simple, go back to large cap, good quality companies. That's exactly what we are doing in our PMS. We may underperform in the short run. Why? Because the momentum is there. But we are all running marathon. We are not running sprint, am I right? Remain calm and composed and create a wealth. So go to large cap, good quality company. That's what you should be doing in this scenario. Rinku Narang is saying, is rules of 90 is era in investment correctly applicable? Is in 80s and 90s market GT was relevant, but in current scenario, is it working? I must tell you, sir, it should work in all scenarios. There will be some exception that happens, that some aberration do happen, but market cap to GDP is a very good strong indicator. Sometimes we believe, this time is different. We keep saying that this time is different, only nothing is different. We go back to the same scenario. So, the rules of 90 on investment, what is that rule? I don't know, sir, what we are talking about. Because one rule of 90 was that replacement cost theory. I don't think that we are talking about now. But market with GDP is very much applicable. Yes, market can digress from that equation for some time. But eventually it has to come back to that. Am I right? So my understanding is that we can't ignore market cap to GDP. It's a very relevant data point, and Warren Buffett keeps saying that time and again. And we should respect Warren Buffett purely because he has that experience. He has created good amount of wealth for the investors. So we should not disrespect the formula of Warren Buffett, which is market cap to GDP. Durang Garnawar sir is saying, is one of your blogs you were written that the time to invest is quite away. What the time would be arriving? I don't think I've said that time is quite away, or if I've made some mistake, please correct me which blog I mentioned that. What I'm saying is that And again, what Rajendra Bhai said is that I'm not saying you should stay away from the market. What I'm trying to say is that invest in good quality large cap right now. Don't chase momentum. That's what I'm trying to say in a mid and small cap. And if you invest in, if you don't need the money, if you invest for more than 3 years, I don't think you need to too much worry about it, because in 3 years period, everything looks extremely fine. So that's what I believe. But sir, if I made some mistake in my blog, please correct me where I mentioned that. Vishali Singh, sir, now that the inflation data for US and India are out, what are your views and what can we expect at the Fed and RBI to upcoming meet, and how will they impact equity market in which sector? So Vishal sir, you have asked a very pertinent question. I thought first I should have put in my PPT and I did not put it. So yesterday, US inflation data came. Excellent data. Inflation came down. What happened to the US market? The US market went down. There is a famous saying in the market: buy on rumor, sell on news. So now Fed, if you look at the CME Fed watch tool, if my memory serves me, more than 90% now believe that there will be a rate cut in September FOMC meeting. September. RBI governor very recently gave an interview and said that doesn't look like that we will see rate cut in the near future. That's what RBI governor, he did not mention that way, but if you look at the way he said, he gave an interview, does not give an understanding that it will be brought down. So one of the reasons is that food inflation continues to remain little sticky. And that will not give a comfort level to the RBI to do the rate cut. In my sense, we are at least 2 months away from the any rate cut. And of course, in 2 months, we'll get more data on the inflation front to form an opinion. So, and how will this impact the equity markets and which sector? I think this rally, which started in October 2023, started on the hope that very soon we'll see the rate cut. Despite no rate cut, market has kept surging on it. And hence, if you ask me logically, if the rate of interest are high, the market should go down. If the rate of interest are low, the market should go up. But that's not the way the market is played out. Despite rate of interest keep moving up by the Fed and by the RBI, market kept on moving up. And hence, to conclude that if the rate of interest comes down, market should go up, I don't think that's the way it's going to play out. Because the reason is very simple, because of valuations. Rahul Kumar, if you can put 2x2 grid for PE 5 years back and now, then it would have been more meaningful comparison, and similarly for the sector specific. Sir, I can tell you with a lot of confidence that 5 years back, the data would not be so bad. Not 70% of the mid and small cap would be commanding price to earning of more than 31 point taken. We love feedback, and that's a very good feedback, Rahul sir, you have given. We will try to do when next time when we present similar kind of data, we will show you what it was 5 years back and what it is now. Maybe that would have made more lot of sense. I agree with you. We will do that actually. But I can tell you often, it's been very, very, it would have been, the data would be much but different as compared to what it is now. Frank, hello Sunil, have you taken the consideration bank charges while repatriating funds from India to outside country? Bank charges are 1 to 1 exchange rate, service charge on top of the exchange rate. Frank sir, I have not done that. Let's be very honest with you. It varies from a bank to bank. I have not done any charges. So if you wish to do that, yes, you adjust for that. and then you do the calculation. You're right. I've not taken into concern. I've just taken into concern the depreciation of the rupee, not the bank charges. Balasundaram sir, just to illustration of your quantified how much the stock are below 30% P ratio. Can we assume it is below 30% P is an attractive stock? Does rating assume this boundary of 30p or any other number? Please help us understand. Okay, Bala sir, we are not saying that PE is a good indicator for individual company to decide. So it doesn't mean that the company which is commanding less than P, 30p, is a good company to invest in. A company which is commanding more than 30p is a bad company to invest in. We are not saying. What we are trying to say is that when you aggregate it, it's a good indicator. But in isolation, it may not be a good indicator. So in our IP also, we look at relative P, what this company has been historically commanding versus what it is commanding. Then we also look at what has been the industry P. And with that, where does it stand? And we also look at what is the return on equity of that company vis-a-vis this, and hence based on that, what kind of price to earning it should be commanding. So I answer both the question, Balasundaram sir. PE in isolation is not a way to look at it. But when you combine as an industry, as an aggregate, it does give a very good indicator where are we trading at. So that's what I wanted to do. And in our what we call IP, we have used various parameters. Even we look at price to earning also, price to earning growth also, PEG, to understand whether valuation is right or high or low. Santosh, your webinars are always informative and full of knowledge. Thanks a lot, sir. Thank you so much for sharing such valuable data with us to create informed investors. One question with respect to SGB, as you said, SGB is tax-free if held till maturity. What happened if I bought SGB in open market after 2 years and if held it for 6 years? Will it be tax-free? My understanding is still tax-free because you holding till the maturity. So if you bought after 2 years also and you hold till next 6 years, it should be tax-free. As long as you held till maturity, so the proceed that you get at the maturity is a tax-free. So yes, my sense is tax-free. I'll reconfirm because with our chartered accountant, I'll come back to you. But as of now, you assume it's a tax-free. Assume it is not tax-free also. Then it will be a long-term capital gain with the 20%, and I think is at cost of indexation. It will be still better than the ETF because ETF is now taxed at your personal income tax rate. Jacob Jose, SGB is supposed to get interest of 2.5% per annum, that is payable half yearly. I have been holding SGB 24 September and SGB August 29 for last 3 years. Never received a single rupee in interest. Looks like it is a bit of taking investors for the ride. Any comments? No, sir. I think you will have received interest on that. So as I told you, I also own 20 gram and 50 gram SGB in two different, and I keep receiving every 6 months. So sir, I must tell you, there is some your understanding mistake. If you have not received in last 3 years, please speak to your what we call depository. Please check your bank account again, or please write to RBI. You will definitely would have received, Jacob sir. There is no reason why you should not receive it, and it comes every 6 months. So that means 1.25% per for that period. Please check. You would definitely would have received. I'm 100% sure, sir. Lata Sundaran Johnson, can you please show slide on taxation of SGB versus ETF? Of course, I'll show that again. This is one, taxation returns. This is the one. I know I've done a lot of this one, and I hope that makes it clear cut. Okay. The return, post-tax return on SGB is 142% versus ETF 114.6%. I hope that makes it clear. Suman sir is asking, will see a correction in the near future? We are hoping to happen. It's not happening. So market is not obliged to, follow our advanced recommendation. We do believe market is little heated, and it does call for a healthy corrections. Sunil Kaul, good evening. Always eager to listen to you. As always, you have been repeatedly saying that we should be now move to large cap and also to realize the situation. My question, does it also pertain to model portfolio subscribers? Who I'm sure we would have got the message, still I need to confirm from your put self. At the same time, we have not seen it churning in our model portfolio since long. Regards. So Sunil sir, if you look at our aggressive, moderate and conservative, even in aggressive portfolio, we are more tilted to our large caps. Okay. So yes, purely because of concerns on the mid and small cap, and there are no churn because as based on our IP, if the what we call stocks doesn't call for an exit, we have not exited. As simple as that. Rashid, we respect your you respect your and Mojo investor continues to empowerment by providing high quality insight. Thank you, sir. I generally invest in small and mid caps, made handsome returns and reduced my investment to 15% by March, April. I agree I could not get some upside but did not reinvest meaningfully after that period. How can I re-entry? My risk profile is high risk, aggressive. Regards. Rashid sir, right now I think you should move to the large cap quality stocks, and that's what you should do that. So please re-enter. Don't try to time the market, because if you try to time the market, probability is very high. Market may go down, you may still not invest, and you will expect market to further go down. Market will make a swift turnaround, and then you will keep waiting for the market to do that. So that's the way you should play out. That's exactly what we are doing in our PMS also. In Feb, we were 90% mid and large cap. We moved to the large cap by somewhere by March or so. In the good quality companies. Why? Because, and of course, we have taken some 10% in liquid funds and so on and so forth. Just in case of the market corrects, will we redeploy that 10% also in the appropriately in the respective large caps or mid cap or small cap, depending on at what time we re-enter that. So what we are doing in PMS, I would suggest the same thing, move to good quality large caps. Kalpit Patel, I stand on more than 70% profit. Can I book profit as per Mojo's code? Please give me advice, or I can sold my small cap and mid cap. Sir, please follow our score available on the MarketsMojo website to take an appropriate call. If the script is still a buy, I wouldn't recommend to do that. If the script is hold and if the script is falling, score is below 60, and if script is falling, please lock in the profits. Mitesh, thanks for your valuable input. Sorry for my long question. Looking at the global markets, where in Europe and USA, overall demand and GDP is down due to inflation. China is getting slower due to trade war. In this case, do you see liquidity in India markets going to remain higher? How is your view? So I think India is giving more liquidity more because of domestic investors than the global investors. Till June, the inflow were negative from the FIIs. In the month of July, we have now become little positive, but inflow is more to the domestic rather than the global investors. And I think our sense is that we don't expect FPI to put in a lot of money in the rest of 2024, because historically, if you look at it, FPI has been not a great investors 2 years in a row. If they invest substantial amount in 1 year, they'll go little slow in the second year. So India received a very handsome inflow last year. Unlikely that we'll repeat that in this year. So we believe that muted inflow from FI in the rest of the year. So I don't think it's going to be. And your question is that Indian market going to remain higher? We do believe Indian market do need a healthy correction. Why? Because the valuation has become extremely rich. Whether you compare India historically or you compare India with the global markets. In both the cases, I think India is trading at a little premium to what it should be commanding. Dr. Davis, what is your strategy for entry and exit in equity? So our strategy in entry and exit is based on our IP. So if our IP suggests to enter the company, we enter. If our IP suggests to exit, we exit from that. So that's how it works. And our IP is a function of 550 parameters, Dr. Saab. Based on that, we decide when to enter and when to exit from a company. I must tell you also one more thing, that our IP on the site and for the PMS is different. Okay, so that's what it is. So what you see IP available on the MarketsMojo side is for the retail investors. What you don't see and we follow is for our HNI customers in PMS. So it may so happen that sometimes what score you see, you may be seeing a buy on the website, but we may be exiting from that company in our PMS and vice versa. Anjali is asking which indicator is better, PEG or price to book in the case of banking finance sector. Very clearly, price to book value is a very good indicator for the banks and financial. Do Mojo PMS invest in liquid funds also or SGB also? Mojo PMS invest in liquid funds, not in the SGB. Do we have more question or Amil, because of time we are saying khatam kar de. दो तीन सवाल ले लो ना यार. People have come, so I know, Amil stays very far from this place, while I stay across the road. So it takes 2 hours for him to reach home, number one. Number two, it's raining very heavily. So in fact, if you look at in our office, very few staff have come. Amil, I understand, थोड़ा दो और सवाल ले लेते हैं यार. Ritesh is saying, love to listen to you and Dr. Mohit sir. Sir, can you share your view on railway stocks? Still steam left in or is it done? So I like one or two railway stocks, but not all stocks in the railway space. Financially, they will do extremely well. But will they be repeat in the market cap? I really doubt. So I like one or two railway stocks, not all. Last question, Amir. Shyam Singh, Sunil, good evening, Sunil ji. Nifty Bs or mutual fund? Where one should invest? Please please reply. Thanks. Nifty Bs or mutual fund? So when you say mutual fund, matlab, are you saying the ETF or the Nifty mutual fund? That's what you are saying? I don't know, sir. Your question is not very clear to me, Shyam sir. I'm a little confused. So I don't invest in mutual funds, so please pardon my ignorance on that. If you can rephrase your question, that will be high. Great. एक और सवाल लेते because श्याम सिंह का सवाल में जवाब दिया नहीं बराबर. So let's take one more question. Madhusudan sir, if I buy sovereign gold bonds from the open market, will I receive the same benefits? How are the tax applied on bonds that are over 4 years old when purchased from the open market? So you get the same benefit, sir, if you buy from the open market. The interest you will get 2.5% is on the, not on the purchase price, is on the price at which the RBI issued the SGB, 2.5%. So be clear that. And if you held till maturity, you will get the same tax, you have a tax-free kind of a stuff. But if you sell after 3 years, then I think you need to pay long-term capital gain on that with the cost of indexation. I hope that answers Madhusudan sir. So with this, thanks a lot everyone taking time out and attending this webinar. I know I may not have been able to take up all questions because of time constraint, and that's the part of life. Am I right? Don't get disheartened. Tuesday again I'll be in front of you at 7 p.m. Please do join me, and there you please put the question and we'll again try to answer those questions to you. With this, thanks a lot. Have a great weekend. I know it's a monsoon time. Be careful when you step out. Why? Because sometimes the rain can be little furious. So I don't want to run into a problem. Take care. Good night.